right, so welcome everyone to tax law number 4. Hard to believe this is our last one. We'll be talking about PA 1000s, local returns, and then we'll move into the military section. But before we start, I had a couple of quick comments that I wanted to talk to you about. So, we understand that right now it's really complicated times, but we're asking if you think you're going to be volunteering this year, if you could please go in, and this is for the Lancaster team. Your team will have a separate email discussion about this, but if you could go in and start signing up for the shifts for the entire season. So on the slide, you'll see I've put a screenshot of what the screen looks like when you're in VSP. And we've had several questions, so I thought I would just show the arrows on the top by the calendar will move the calendar forward or backwards. So if any of you were trying to sign up and weren't able to, just use the arrows and you'll be able to get to those other months. The next thing is I just wanted to remind everyone, when you're doing client intake, about middle of the page, there's a question regarding identity protection PIN numbers, and clients need to answer that question yes or no. I'd encourage you to question them on that. We've been seeing more and more clients who do have identity protection PIN numbers, and if we don't put them in when we go to e-file the return, the e-file will reject and we'll have to go back to the client to obtain that PIN number so that we can submit the return. They get a letter from the IRS every year. Once you have had one, so if you had an IP PIN number last year, you will need one for this year also. For all new volunteers, state and local, the entry into tax layer, that is not yet available in the practice lab. Hopefully it will be in early in January, and we can cover that in the open sessions. If not, we'll look at having a special session where we will show you how to do all that data entry. Anyone who's trying to get into the practice lab, we had sent out an email on November the 9th that has a link and a PDF that will be available for you. Any questions you have, as we've done before, enter them in the chat. We'll have a halfway point that we'll stop when we come back, answer questions, and then we'll do questions at the end. And then just as a reminder, hopefully everyone has picked up all their IRS materials, their 4012s and their 6744s. And with that, Jared, I'll turn it over to you. Jared can't hear you.
Okay, how are we doing audio-wise now?
Great.
Perfect. All right. Well, welcome everyone to our fourth and final session here for our tax training for VITA. What we're going to be doing is shifting gears a little bit and actually heading. Okay, see if we're back on again. Okay. All right. Hopefully we are in good shape here for audio again, but we're in our fourth and final session, shifting gears for state and local. So we're going to be actually covering material that is not going to be in your 4012 and really going over a little bit of information. So we're going to be covering Pennsylvania taxes and also a little bit of Lancaster County. So for those of you not from Lancaster County, the rules are fairly similar, but you're going to see a couple differences in terms of really coding for local returns. But for the most part, the local return process will be fairly similar coming out of the tax layer program. But really taking a look at Pennsylvania in particular, for VITA purposes, Pennsylvania is the only return that we're going to be preparing for our VITA clients. So we're not going to be doing any VITA state returns, not going through the process of preparing a second or third return for individuals. So Pennsylvania only is the process that VITA is going to follow for the current year, just to make it a lot easier. It's a whole lot cleaner if we just do one return. And as you may see, Pennsylvania is going to be complex or of its own intricacies enough. However, you can do multi-state returns for friends and family. So there's no prohibition against doing those as long as they're not for a VITA client. Now, we first started our training session by talking about filing requirements, who must file a return. And for federal purposes, we looked at a number of things, including how much gross income someone may have had, what their filing status may have been, And also their age came into play to determine whether or not they had to file a federal return. In Pennsylvania, the threshold is actually much lower. You actually have to file a Pennsylvania return if you have more than $33 of income, irrespective of whether or not you owe tax on your return. So it doesn't matter if you had your tax covered by withholding, or maybe you don't have to pay tax due to some credits we're going to be talking about in a little bit. If you have more than $33 of gross income, you are expected to file a Pennsylvania income tax return. In addition, you also have to file a return if you have any losses from a sole proprietorship as an individual for gains, that type of thing, partner in a partnership or a Pennsylvania S corporation. Typically, this scenario does not apply for VITA since we do not handle K1s. We don't handle losses from a sole proprietorship. But if you do have any of those activities, you would have to file a Pennsylvania return. What's also unique is Pennsylvania does not have an exemption for minors. So no matter what age an individual would be, if they're an 8-year-old who has a couple dollars of investment income, they're technically required to file a Pennsylvania return. For Lancaster County, and actually applies for other municipalities as well, this is only for earned income. So when we talk about local returns, it's only going to be for income you have from employment or earned income or net profits. So that would be anything from wages, maybe a sole proprietorship, or if you're an active partner in a partnership. Those would be the areas that would be subject to tax. So for Lancaster County, we're looking for a local return if you lived in Lancaster County or in the Octorara School District, which is actually over in Chester County, for any part of 2021, and you had earned income. Now, fortunately for Lancaster County and local returns, there is a exemption for minors. So if you are 16 and over, that is when the tax applies. If you're under the age of 16, meaning 15 or younger, you do not have a local return requirement. Now, hopefully your employer knew when you turn 16 and change your wages accordingly. But if you have an individual comes in, they happen to be a minor child, they were working for someone, and they actually end up withholding local wages, we can file a local return just to get a refund back. So that is entirely possible going through that process. Now, one of the reasons we talk about why Pennsylvania is unique, in addition to being a commonwealth rather than a state, just more of a legal definition, Pennsylvania has changed the way in which we tax individuals. So despite the fact the federal has its own set of rules and a lot of intricacies and complexities and over 100 years now of case law and statute, Pennsylvania only taxes income based on 8 different classes. And so what we're going to talk about a little bit more depth of where these areas are coming from, mainly from wages, interest, dividends, business income, gains and losses from the sale of property. So those first 5 are going to be within scope. The next 2 are not, rents and royalties. So if someone has rental income or if they have royalty income from maybe writing a book or music license, that's going to be outside the scope of VITA. Same thing with the state and trust income. So that typically would be coming through on a K1 and would be outside the scope of the VITA returns. What would be in scope is our 8th category, and that's actually gambling and lottery winnings. So that includes winnings paid by the Pennsylvania Lottery and any Powerball or Mega Millions prizes. So a couple years ago, Pennsylvania would actually exclude winnings that were actually for tickets bought in Pennsylvania. However, that has been repealed. So any gambling and lottery winnings would be taxable for Pennsylvania. Now, what's unique about Pennsylvania? Again, we talk about 8 classes of income. So if you're taking a look at a Pennsylvania return, a PA 40 for the first time, just bear in mind that Pennsylvania has some really intricate rules. So technically, you cannot offset losses from one category with income from another. So for example, if you had wage income of $10,000 and you had a $2,000 loss from the sale of stock, for federal purposes, you're allowed to deduct that $2,000 against your wage income. For Pennsylvania, you are not. So we cannot offset losses from one category against income from another. Similarly, you cannot offset income and losses between spouses. So while the PA 40 looks like a single return, it technically is actually a separate return for each taxpayer. So the information will be reported together, but you're not allowed to offset income from one spouse with a loss from another. So similar situation, let's just assume that we have a taxpayer and spouse. Both have investment accounts. One made $1,000 in their investment account off capital gains. The other lost $2,000. If you take a look at the PA 40 and you've properly coded everything between taxpayer, spouse, and joint, we cannot offset that spouse's $2,000 loss against the taxpayer's $1,000 of gain. So in the PA 40, you'll see $1,000 sitting on the gain line. So that's not a mistake. That's actually how the calculation will occur. Now, when we talk about Pennsylvania, if the income is not in one of these 8 classes, it's not taxable for Pennsylvania purposes. So there's a lot of actually tax exempt income here for PA. If you may have noticed around our communities, we have a lot of retirement areas. And one of the things we're going to realize is not necessarily the fantastic weather we have all winter long that drives people to retire in PA, but the fact we don't actually have tax on retirement income. So Pennsylvania does not tax Social Security benefits, does not tax railroad retirement benefits. We talked about those during the income session. It does not tax pension and retirement distributions as long as the individual has met the eligible retirement age and retired. So those are some areas we had talked a little bit about with the 1099-R. A Code 7 is not going to be taxable for Pennsylvania. A Code 1 would be because the individual had retired or had taken payments before normal retirement age. But we do have the ability to recover initial contributions first. So a little bit of a wrinkle there. Just want to mention again, if we have a 1099-R with a Code 1, we may need to do a little bit more calculation with the return and can offset some of that taxability that's running through the PA return. We do get to recover the amounts that the employee has contributed to the plan. Unemployment compensation is not taxable. Sick pay, disability payments are not taxable. Alimony, irrespective of whether or not it's taxable for federal, is not taxable for PA. Also, inheritances and death benefits are not taxable. And we'll also talk a little bit more about active military duty pay at the end of our session today. So just to hit a couple of the areas that are taxable, just want to kind of touch base on some wage activity here. So what will happen if you enter the W-2? Tax layer kind of goes through a presumption that the box 1 income for federal taxable is also going to be your same amount taxable for Social Security, Medicare, and also state. But quite often, particularly in PA, we're going to have a different taxable income on the W-2 than what we have for federal purposes. So the main purpose behind there is Pennsylvania does not give a deduction for retirement plan contributions. And where we see that come through in that prior slide, we just mentioned that Pennsylvania does not tax retirement distributions. So Pennsylvania effectively had the first Roth type account. They did not give a deduction for money going in, but they don't tax it on its way out. So typically what will happen is wages will be higher during a period of time in which the employee is working, contributing to a 401k or maybe 403b plan through their employer. So their wages are going to be a little bit higher for PA, but then when they retire, especially if they're here in PA, they do not pay taxes on those distributions. So just as a reminder, when you see the W-2 information, make sure you enter it exactly in the W-2 worksheet and tax layer, making sure that you have the correct state and local wages. So the state wages are going to be in box 16. The state withholding is going to be in box 17. So every once in a while, the W-2s may have a additional information, maybe the local section, that is going to maybe have a $52 withholding. If we have 2 withholdings in there, one of them is probably what we call the local services tax. That is actually not the appropriate place for that to be entered. So that actually does not get entered on the W-2 worksheet. In fact, what we want to enter is just the amount of local wages and any local withholding. Here in Lancaster County, typically what we suggest that you do, there is a code that can go in right after the local withholding. We recommend you put a code of 36 in there. That'll allow you to actually prepare the local return through the tax layer system. So we don't actually have to do those by hand. So just as a reminder, just enter the W-2 information exactly as you see it on the W-2 screen in tax layer. Everything should flow to the correct places. Just watch it. We don't have additional information on there. And if you have any questions, probably the best place is maybe just double check with your site coordinator about what information to enter in off the W-2. Now, one other interesting part about PA is that Pennsylvania has an agreement with surrounding states, basically to allow for a resident to work in another jurisdiction, but not have to worry about filing taxes in that other state. So particularly here in the Lancaster, York area, we have a lot of people that may work in Maryland. So fortunately, Maryland is one of the reciprocal states, meaning if you have a Maryland employer, they should be withholding Pennsylvania taxes for you, not Maryland taxes. The interesting part when we take a look and we put this thing in alphabetical order, the very first state that pops up is a reciprocal state. And mainly we've done this with neighboring states, happens to be the state of Indiana. Now, I personally don't know anyone who's commuting on a daily basis to Indianapolis for work, but theoretically, if you're working in Indiana, you would have Pennsylvania taxes withheld, not Indiana taxes. So same with our surrounding states in Maryland, New Jersey, Ohio, Virginia, and our little touch point there, West Virginia. If you work in any of those jurisdictions, those employers should be withholding PA tax. It's going to make it a very easy return to file because, again, we're only going to be filing a PA return. Now, for some reason that the employer does not hold PA tax, and instead they're actually withholding tax from Maryland or New Jersey, it becomes a little bit more complex. We actually have to file an out-of-state return to get a refund for taxes paid, and the taxpayer is going to have to owe taxes on all of their income in PA and just wait to get a credit back from the other state. A couple other issues we run into is you'll notice that there are two neighboring states on our borders that do not have a reciprocal agreement. So New York is one and Delaware is another. So if people are working in either of those states, unfortunately, they're going to have to file an out-of-state return and try and get a tax credit back in PA. So it gets a little bit more complex. Delaware, we may or may not have a couple of people working there on occasion. New York, we may see a couple more people working with New York employers because of the telecommuting options here during COVID. New York, unfortunately, does not reciprocate with anyone. They basically feel that any tax money should be that of New York, and we just have to file separate returns. So again, the problem we run into, a little bit more complex of a situation. So we do not actually run those returns through the VITA program. Now, some good news, though. We actually do get some deductions for Pennsylvania purposes for unreimbursed employee expenses. Now, we do not have these for federal purposes anymore. So they actually had been removed when we had some changes to itemized deductions. That's why we didn't talk about employee business expenses during our deduction section. However, Pennsylvania does allow employees to deduct expenses incurred for work purposes as long as they meet some basic requirements. So a couple of things that we have to take a look at is they have to be ordinary and customary. So they have to be generally used in that trade or business, the occupation which you're working. They actually have to be paid while you're performing your duties of your employment. They have to be reasonable amount and not excessive. So what we mean by reasonable amount, if you have to take a trip to Europe in order to meet with a client or a vendor, that is entirely permissible. You're allowed to deduct airfare. That includes either business or first class accommodation. So airfare is not a problem. If you instead decided you would like to take a cruise to Europe and have a nice little 2-week journey over across the Atlantic, that is not going to be deductible. That's not reasonable and would be considered excessive. It also has to be incurred in order for you to help perform your duties of your employment. So it has to be there incurred for your job and has to be directly related to actually performing your job as well. So Pennsylvania has actually gotten a little bit more strict in terms of allowing or disallowing some of these expenses. So what the rule is for Pennsylvania is that the employee may not be reimbursed by the employer. So if the employee has the option to be reimbursed by the employer and simply chooses not to, Pennsylvania will not allow a deduction. So you're not going to get an unreimbursed employee expense because you forgot to turn in your meal receipts to your employer. Another situation where this may arise, and I've gotten the question before, particularly for people who may work for an employer who has a mileage reimbursement rate that's less than the federal rate. Well, it doesn't matter if the employer is only going to give you a 20 cents per mile reimbursement. PA will not give you the balance. So if you get any reimbursement from your employer, you are not eligible for those expenses for the unreimbursed expenses. So that is just one thing to keep in mind. So we always have to ask the question of the taxpayer, would your employer have reimbursed you for these costs? And if so, then we can't take them for PA. These also would work for local. So if we get a deduction for PA, we also can carry this over for the local return. So just want to talk a little bit more about what our common expenses are. So where we typically see this would be for union dues. So if we have educators, if we have people that work for government agencies, if we have people that are in manufacturing or maybe higher education that have union dues, these are deductible. Now, you may have to ask how much they have in union dues. Sometimes they're actually shown on the box 14 of the W-2. Other times they may have been paid out of pocket or not through withholding. So we may need to just double check and ask how much they have in union dues. Work clothing and uniforms. Now, what is unique about these is we have to be cautious. So work uniform and clothing have to be required to be purchased by the employer. And here's the important part. They're not adaptable to general use. So if you have to go work for a grocery store, they require that you wear certain color clothing, maybe a black shirt and black pants. That's not actually a unreimbursed employee expense. That's actually adaptable for general use. Same way, if you have an employer that says that you would have to wear something a little bit more formal, maybe a nice dress or a sport coat and tie, those are not deductible expenses. They're adaptable to general use. What we mean by these work clothing would be things like safety boots, maybe steel tip shoes, clothing that might be bright in color in nature if you're working outside. Those are things that we would typically view as work clothing in uniforms that would be required by the employer and not adaptable to general use. So getting a very nice, heavy Carhartt jacket to work outside as a landscaper would not be a unreimbursed employee expense. That's actually allowed to be used at any point in time. So it's adaptable to general use. Small tools and supplies, where we typically would see this within the VITA program is the educator expenses that we had talked about during our adjustments to income. So educator expenses, those K through 12 expenses, are deductible as a unreimbursed employee expense. Now, for federal purposes, we had a cap of $250. We do not have that cap for PA. So if someone actually had $340 of unreimbursed school supplies, they can actually take the full $340. Most times, other occupations, you're probably going to get reimbursed if they have to go pick up some supplies for a job that they don't want to run back to the home office. So again, we just have to double check to make sure they're not getting reimbursed. Professional license fees. So we may see clients that come in that might need a professional license from the Bureau of Licensing in PA. So that could be anyone from beauticians to attorneys to nursing. Any of those areas where we have a license fee that is required to be paid in order to work, but the employer is not going to reimburse, that would be a deductible expense. Same thing if they have any conferences or trainings that aren't covered by an employer, that can be deductible as well. Vehicle expenses, as long as you're not commuting costs. So if someone's incurring travel going between job locations or in a area where they're actually moving or working outside the living area, that could be a deductible vehicle expense. That includes parking and fees and other tolls, that type of thing, incurred while traveling. Also, travel expenses while you're away from home overnight. So if you're sent out of the area and you have to have a hotel room, that would be considered deductible travel. And any meals and entertainment would also be deductible at 100% of the incurred amount. Now, switching gears a little bit, we're going to head back over to interest income. And generally, interest income is going to be very, very similar to what we have for federal. Now, there are going to be a couple exceptions. So Pennsylvania is actually not going to tax interest from following sources. So it does not tax interest from the U.S. government. What we mean by that is savings bond interest. So if you have a 1099 INT and you see an amount in box 3, that's interest on U.S. government securities. That'll be taxable for federal, but not for state purposes. Same thing if you have interest from the Commonwealth of Pennsylvania or any municipal governments within Pennsylvania. So that is actually in a municipal bond interest. Now, municipal bond interest is actually not taxable at the federal level, but Pennsylvania is only going to exclude municipal bond interest from its own Commonwealth or its municipal government. So if you have municipal bonds from Iowa or Ohio, they're actually going to be taxable here in PA. If you have bonds from Puerto Rico or the Virgin Islands, or the one I would love to see at some point, if anyone actually has a copy of a bond from Guam, those are going to be exempt as well. So that's not going to be taxable. Now, fortunately, in TaxSlayer, we actually have a fairly very nice place to go ahead and modify that within the add and edit button. When you go ahead and you put in the interest income, you can actually go ahead and modify that by selecting the amount. Now, in general, we'll probably want to, kind of take a look overall about what would be taxable interest in PA, because we're going to talk in just a minute that it may not be worthwhile for us to kind of pour through brokerage statements and take a look and see how much exempt interest we have, because our taxpayers may be eligible for a complete tax forgiveness. So if you have pages and pages and pages of brokerage statement, you may not have to go through and try and double check and see, if 3% of a mutual fund is exempt from PA. Let's do the math and do the calculation. The one big issue we have for VITA clients is actually the next area that we're going to talk about, and that's tax forgiveness. So we mentioned in Pennsylvania that it's a very low threshold for filing. You only need $33 of income. Technically, Pennsylvania has a flat tax rate. Happens to be a very even 3.07%. But that's supposed to be a constitutional requirement that everyone in the Commonwealth will pay 3.07%. However, the legislature came up with a way in which we actually have a graduated rate, and we backed into that by creating a Schedule SP. And the Schedule SP is actually a mechanism of tax forgiveness. Now, when we talk about tax forgiveness, you have to tell TaxSlayer the taxpayer is eligible. It will not automatically calculate this without you going in and letting TaxSlayer know that the taxpayer is eligible for tax forgiveness. In most cases, we'd probably suggest for every client, go ahead and indicate that they are eligible for tax forgiveness. Now, I do want to make a quick caution here, and you'll see this at the very bottom point of the slide. If the taxpayer is a dependent of another party, so if you have a college student coming in and they're a dependent of their parents, in order for that taxpayer to be eligible for tax forgiveness, the parent must also be eligible for tax forgiveness. So we have to double check with that individual. And again, kind of words of caution for a college student coming in. You just want to verify that they are in fact going to be a dependent of someone else. And if they are, that whether or not those parents would be eligible for tax forgiveness themselves. If that's the case, then the dependent could be. Also, if you're going to be filing married filings separately, you do need the spouse's income in order to help determine tax forgiveness. So the general rule of thumb is go ahead and indicate that the taxpayer will be eligible for tax forgiveness. And as long as they meet the other qualifications, they should be good. Now, just one other thing we have to watch, that Pennsylvania is going to require that we add back certain non-taxable income. And what we're looking at here is any amounts that were received by the taxpayer that's actually giving them an economic benefit. So even though alimony is not taxable for PA purposes, PA considers that as enrichment. It's getting compensation from other sources, even though it's not taxable. That includes non-taxable interest. It also includes inheritance. Also includes the non-taxable educational assistance. And here's one that's kind of a kicker. The gain excluded from the sale of a principal residence. So not taxable for PA, not taxable for federal when you're selling your home and you meet the qualifying rules. 2 out of 5 years for ownership and use, and the gains less than $250,000 for individuals, $500,000 for married filing separately. But we actually have to add these amounts back in on the Schedule SP. Now, these amounts are not automatically calculating. There's no spot in our tax layer to go put inheritance or even go through the excluded gain from the sale of principal residence. We actually have to ask the client that information just to be sure. Now, most likely, they're probably going to let you know that they had a sale of a principal residence. They're probably bringing some documentation. But we do want to just double check. Inheritance is probably the biggest one we'll see on there that we just need to verify with them. Did they receive any inheritance? Now, not taxable for federal or state, but could impact their ability to claim the Schedule SP. Now, the good news about the tax layer program is actually pretty good to do the calculations. So as long as the information is in there correctly, it will go through and generate any applicable tax credits. Just a couple other things I want to mention here about the Pennsylvania returns, that we do have a couple unique features. So if an individual has purchased a non-retirement annuity, so we're basically talking about a privately purchased commercial annuity. And these are basically ones in which they might be sold by an insurance or mutual fund company or a gift annuity. The basic structure here is that the taxpayer is going to give their money over to the annuitized annuity company, and the annuity company is going to give them a series of payments over time. That's actually not a retirement annuity. So Pennsylvania is going to treat these as their an investment contract. So these amounts are actually reported on a 1099-R. So the one way you're going to take a look at this is that if you see a code 7D or D7 in box 7 of the 1099-R, that taxable amount is going to flow to PA as interest income. So if you're reviewing a PA return and the interest income is much higher than federal, and you're not quite sure where the interest came from, take a look and see on the Schedule A for PA, do we have any interest income coming from an annuity? And that's probably what's happening. Another kind of unique issue for Pennsylvania is you'll have a question on the return that asks about use tax. So use tax is a area where it's a correlated to sales tax. So Pennsylvania, and we could have a whole separate session just talking about Pennsylvania sales tax and the applicability, which items were taxable, which ones were not. However, if you buy an item in Pennsylvania, the retailer is going to charge you the appropriate amount of tax. Likewise, most of your online retailers probably have a PA presence and are also going to be charging you tax based on the items or services you're buying. Now, use tax arises when we have taxpayers who purchase items either out of state. So again, we're very close to states like Delaware. Delaware, in case you haven't been there before, as soon as you're going across the border, they're going to have a big welcome to Delaware sign right underneath that, home of tax-free shopping. So Delaware advertises that there is zero sales tax in Delaware. So theoretically, if you drove down to Delaware and you decided you'd like to buy a new appliances or furniture set, you're not going to pay sales tax in Delaware. But once you bring those items back into Pennsylvania, you actually now owe use tax for those items. So you didn't pay Pennsylvania sales tax, but you're using it in PA. So it's going to be a use tax. Now, the good news is before anyone panics and worries the PA government's going to come after them, this is a voluntary reporting process for individuals. Businesses have a little bit of a different issue. They actually have to report their use tax, but individuals have a voluntary response. And the way that PA collects use tax is they actually have a question on the return. Would you like to pay any use tax on your PA 40? The majority of our clients within VITA are going to say, I have no idea what you're talking about. And that's fine. Zero is fine. You do not have to report anything. Again, it's a voluntary disclosure. I have had clients in the past that have brought me schedules of items that they had purchased out of state, or maybe they bought through the internet and the company did not charge them sales tax. So they said, well, here's how much I actually owe. So can we put this on the return? You absolutely can. It's a voluntary process. If someone would like to pay use tax, but they didn't keep accurate receipts, and I don't blame them, it's a pretty complex process, you can actually use a table to go ahead and calculate how much use tax would be due. This is going to be based on income. So I just have a couple of the traditional VITA client kind of income brackets in here. So $15,000 or less would have a $6 amount due to PA. Between $15,000 and $30,000 goes up to $12. Between $30,000 and $50,000 goes all the way up to $17 tax due. So this is an opportunity if you'd like to voluntarily contribute to the Commonwealth of Pennsylvania Treasury Fund. You may certainly do that with the return. However, we have the majority of our returns not reporting this going through the process. Just want to kind of mention there are a couple other deductions we can take on a return. So kind of the big ones we see would be a Section 529 contribution. Section 529 plan is actually a college savings plan. So it allows you to put money aside into an account and the proceeds will grow tax-free as long as the distributions are used for qualifying higher education costs. Now, the good news for Pennsylvania is a taxpayer can actually deduct up to $15,000. And if they're married filing jointly, it can be up to $30,000 per beneficiary per year. So what this means is that an individual can actually contribute money to a beneficiary's retirement or 529 plan. The good news is that plan does not need to be here in PA. It doesn't have to be a PA sponsored plan. The individual does not need to be a dependent on your return, and the beneficiary does not even need to live in PA. So there's a lot of benefit. Maybe you have people who might be making a contribution on behalf of their grandchildren, maybe putting a couple $100s in per year. This is a deductible item. Now, the deduction is going to be the lower of the contribution or the PA taxable income. So if an individual has $1,000 of PA taxable income, they contribute $2,000. we can only take up to that $1,000. We can't get a refund based on a Section 529 contribution. Similarly, the HSA contribution is also deductible. Now, what's going to happen is if a taxpayer has an HSA contribution that they've deducted on the federal return, meaning that they have made an after-tax contribution to their plan. Most cases, what we're going to see are taxpayers who have made a contribution on a pre-tax basis, meaning that they had a deduction from payroll or their employer had made a contribution on their behalf. These are not deductible costs. What we're looking at is someone who has actually made a separate contribution to their HSA. Again, they can make that up to the due date of the return to count for the prior year. Any out of pocket or basically what we call after-tax contributions would qualify. So if it's made on outside of the employment context, we can take a federal deduction, and you're also allowed for PA. One last area that we have here is a PA deduction. It's actually a PA able contribution. And the PA able account is actually Pennsylvania Achieving a Better Life Experience. And this is a program designed very similar to the 529 plan, but it's actually designed for individuals for disability related expenses. So this is a tax-free plan. You make contributions to the program, and the individual can actually withdraw money to be used for their care expenses. So what happens is the PA able program allows the individual to keep their government benefits. It does not count against them, but it can be used for additional care expenses. Now, a taxpayer can actually deduct up to $15,000 in contribution per beneficiary per year. And similar to the 529, it's going to be the lower of their actual contribution or their PA taxable income. So when we take a look at a married filing jointly, we had $30,000 for the 529 plan. Unfortunately, for the PA able, it's only up to $15,000 for both taxpayer and spouse, but that's per beneficiary. If there's multiple beneficiaries, you can certainly go ahead and take that into account. So what we can take so just to describe that a little bit, federal income is basically limiting the total annual contributions from everyone for a PA able program. But the taxpayer can take up to $15,000 and the spouse can take up to $15,000 as well. In order to take that as a deduction, you have to complete the Pennsylvania Schedule O, which is actually automatically generated by TaxSlayer. One other note that we have for the PA returns is that we have to actually enter the PA school district code that was where the taxpayer resided as of December 31st. So what we're going to be looking at here, I actually have on your screen the tax codes for Lancaster County. You'll see that they all start with the prefix of 36. That's the Lancaster County code at the PA level. So what we are going to be suggesting is that we verify where the taxpayer lives by having a municipal check system. So we actually have a link to a website that you can actually enter the taxpayer's address, and the state will actually tell you where they live from the municipality and a school district level. Most people probably know the school district they live in. We had just come through kind of school board elections. We have a lot of activity that people would probably know what school district they are, but we do want to double check that. So we can use that lookup system. So we do want to enter that 5-digit code. Again, what we take a look at for taxpayers who have moved. If they're coming into tax preparation and they've moved since the end of last year, we certainly want their current address to be on the returns. However, for the PA 40, we do want the school district that they were living at December 31st. So we do want to make sure that we have the appropriate school district where they were living whenever they had completed the 2021 year. So we need to find out where they were at New Year's Eve, and that'll help determine which code we put on the return. So with that, we're actually at our first break of the evening. So we'll go ahead and take a 5-minute break here and come back at around 6:16, and we'd turn it over and see if we can get Jeff to hop on with a couple questions that may have arisen between our first session and today.
All right, thanks, Jared. For Pennsylvania unemployment, Pennsylvania unreimbursed expenses, do nursing scrubs count as clothing?
Yeah, so typically things like a nursing scrub would be considered a work uniform. So you would be eligible to take that as a deduction. So it's required for your employment the clothing would be used specifically for the job. So that would be a deductible expense. Now, kind of the criteria we've often used in the past is to try and see would you be comfortable wearing your work clothing out in the normal course of kind of your personal life? Probably years ago, we probably had a better clear-cut case of what would be considered work attire and personal attire. But when you take a look at people today that show up at a retail location, still looking like they never got changed out of leaving their bed in the morning, becomes a little bit more questionable as people are walking around in onesies and pajamas and robes and slippers walking around. But traditionally, if the clothing is only really suitable for work conditions like a nursing scrub or maybe coveralls, that would be considered a direct work expense. So that would be eligible.
All right. For Pennsylvania tax forgiveness, are retirement rollovers counted in income?
So for Pennsylvania tax forgiveness, the rollover would not be taxable income. So again, Pennsylvania is looking at any type of economic enrichment. So the areas that they're looking at basically adding to income for purposes of qualification for SP would be things like alimony, inheritance, and sale from the principal residence. So those are all areas where the taxpayer has actually benefited economically. They've actually gotten more money than otherwise is reported as taxable income. But for a rollover that's not taxable income, it's actually their own money just moving from one account to another.
All right. This has to do with Pennsylvania income limits. If a dependent has over $33 in income, can their parent list that income on their own return to preclude the need for the dependent to file a tax return?
Well, so for federal purposes, there's actually an opportunity for a parent to elect to report the child's income on their return. And it can be done in a variety of circumstances. It just is a little bit easier. However, you probably pay a little bit more tax because the parent's rate is probably higher than the child's, but you do avoid the kiddie tax rules and a bunch of other unique areas. Unfortunately, Pennsylvania does not have that same opportunity. So if the income is reported in the child's name, the technical requirement would be for that child to file a Pennsylvania return.
All right. Now I have some questions from the chat. Does VITA prepare out-of-state returns in situations where there's no PA tax, but there was tax withheld in another state, New Jersey, for example?
So I believe the position, Jeff, and you can correct me if I'm wrong, or Michelle can hop in, that for VITA clients, we're only going to prepare PA returns.
Yes, that's correct.
So even if they kind of moved here from another state, if they moved from, say, Michigan to Pennsylvania in February and they're coming in to get their taxes done, we still would not prepare that Michigan return. So the state return we'd prepare would only be one state, and that one state is Pennsylvania.
Yep, that's correct. Thank you. This question has to do with unreimbursed expenses. What about your internet, your ISP service when you're working from home?
Yeah, so the working from home gets to be very, very tricky because what we're looking at here is Pennsylvania basically would require you to have an official home office to deduct some of those working from home expenses. The other issue we run into outside of trying to qualify for a home office, which becomes a bit of an issue, particularly for PA, because now you have to have an exclusive place that you're working. So it cannot be the dining room table, can't be a shared area, has to be an exclusive use or exclusive part of the home that you're using. Is that may also subject your utility bills to sales and use tax. It would also take that part of your property and exclude it from the gain exclusion once you sell your property. So even if you only used it for a brief period of time, if you're taking 5% of your home as a home office, it's going to actually make 5% of your sale not eligible for the PA portion of the home sale rule. So kind of a long way of saying that technically, no, the costs incurred for working from home would not be considered under Pennsylvania law as a deductible item for PAUE. The other issue we run into is unless there's a way that you can prove that the internet was only used for business purposes, it's going to fall into a mixed use category. So it'd be a little bit tougher for us to kind of get over that hurdle for PA. They actually have a brochure, I believe, that they had released a little bit ago that kind of talks about the rules of those areas. So typically PA will not be granting kind of a carte blanche for anyone to take internet expenses by working from home.
Okay. I'll summarize this next question. An experienced preparer is asking why we would put 36 in the local code from the W-2 rather than actual value. So initially we had to do it to move Slayer along. Let's see what happens this year. I don't think it's as concerning as this volunteer thinks, but let's see how Slayer operates. And then at a site level, if the guidance is to put in the value from the local code, then you can go do that. Next question, is annuity earnings tax only once taken, or if, for example, you earned interest over several years, would you need to somehow account for that interest year over year until you took it?
No. So basically what we take a look at here is the only time it's going to be reported is when it's coming through as a distribution on a 1099-R. So if you have an annuity and it hasn't actually been paying out, it's just accumulating income. You might be getting a statement at the end of the year to say that you have an increase in the value of your annuity or your contract. We only have taxability whenever that money is actually withdrawn. So again, it has to be an economic benefit. So that only occurs whenever there's a withdrawal of money. So the annual appreciation would not have to be reported. So only anything coming through a 1099-R.
All right. Can someone on disability get the earned income credit?
So kind of a unique area. So technically, if you're on disability, you're probably not going to be eligible for W-2 earnings, and you may be cautious about having self-employment earnings. However, if you are receiving disability retirement benefits, and that is coming to you because you haven't yet reached the minimum retirement age, those amounts of retirement benefit are eligible to be treated as earned income for the purposes of the earned income credit. So the main area that we take a look at for someone being eligible for the earned income credit while on disability is if they're getting the disability payments before they reach the required or minimum retirement age.
Okay. If you receive grants for school, can you still qualify for the AOC?
Yeah. So if you are getting grants or scholarships, you can still qualify for the American Opportunity Credit and actually Lifetime Learning Credit. If these are non-taxable grants and scholarships, they have to reduce the amount of eligible costs. So for example, if you have tuition and qualifying fees of $20,000 and you get a $10,000 scholarship or grant, we're going to reduce that $20,000 by the $10,000 received. However, you still have $10,000 of eligible costs to apply for either of the credits.
Got it. Okay. Does Pennsylvania allow gambling winnings to be offset by losses without itemizing deduction?
Yeah. So fortunately, for the gambling winnings, and I apologize, I should have mentioned that. For federal purposes, we could take the losses only if we itemized. For PA, you can take the gambling losses against the gambling winnings. And again, it can only be up to the amount of winnings. And if you have a taxpayer and a spouse, each one's going to have to report their own gambling winnings and own gambling losses.
Okay. If you work as a caregiver for Pennsylvania and are exempt from paying federal taxes, do you still qualify for EIC?
Okay, so this kind of sounds like the Medicare waiver that we had reviewed back in the EIC credit portion. So yes, so we actually went through that in our third session to talk about how we enter the information of the W-2, and you can actually have it excluded for federal purposes, and that the wages would actually still count for earned income credit, though, for the earned income credit calculation.
Okay. Last question, but if others have questions, please put them in the chat. Regarding unreimbursed employee compensation for vehicle expenses, are both mileage rate and actual expense method to be used?
For VITA purposes, we're only using the mileage method, I believe.
That's right.
Actual gets a little bit more complex because theoretically, if you own the vehicle, you have to do a depreciation calculation. You also have to collect all the information based on repairs, fuel, oil changes, routine maintenance, that type of thing. So the actual mileage method is relatively complex, and it's not utilized for VITA. However, if you're doing a personal return, you can certainly do that if you wish within the program. But for VITA purposes, it'd be the mileage method only for reimbursement.
Got it. Okay, thanks. And that was the last question.
Oh, okay, perfect. All right. So what we're going to be doing now is actually getting back into our information and talking a little bit more about some other areas about PA. And then once we're done with this, I'm going to hop over and talk a little bit about some deceased taxpayers. And then we're going to finish off with some military tax issues. So we'll kind of let you know the rest of the agenda here. So one of the things we had talked about was we may have individuals coming into VITA sites and they don't owe federal tax. They're beneath the filing threshold. They're going to qualify for the SP program, so they don't actually owe any PA tax. But we actually get a lot of people coming into VITA just to file what we call the property tax rent rebate claim. So this is actually for eligible Pennsylvanians. Effectively, what we're looking at are individuals that qualify based on age and income to get a portion of their property or rent rebate given back to them. Now, the program itself falls into three main categories of eligible individuals. So we have seniors, age 65 or older, widows or widowers who are age 50 or older, and anyone with disabilities age 18 or older. Now, we have two different areas. They're both reported on the same form. It's going to be a PA 1000, which is actually prepared within TaxSlayer. And the income limitations, you can earn up to $35,000 a year from homeowners or up to $15,000 for renters. Now, traditionally, we're going to take a look that it's not all of your income. It's going to be effectively your income that's subject to PA tax plus 50% of your Social Security and railroad benefits. So that's where we basically come up with that calculation. Now, very similar to the SP program, we also have to add back a couple other items. So those are the same things. It's going to be the inheritance. It's going to be alimony, any spousal support, which would kind of be like alimony, and any gain from the sale of a principal residence are going to be included in income. So we have to add those back in to see whether or not the individual is going to qualify. Now, the maximum rebate is traditionally $650. So if a taxpayer comes in and we do the calculation, and TaxSlayer is very good at doing the PA 1000, it may indicate that they're going to get a $650 rebate. Now, if the same individual comes back the subsequent year and says, I don't know what you did on my return, but PA actually gave me more money than the $650 that we applied for. Is there a problem? Do I have to send it back? Is the government going to come after me? Well, fortunately, no, because the PA property tax rent rebate, the $650s are a standard maximum rebate. However, if they meet certain conditions, it's a property tax that is going to be from homeowners, can be increased by an additional 50% for any senior households, as long as they meet the following condition. They have less than $30,000 in income, and more than 15% of their income is used to pay property taxes. So that actually will give them another possible $325 on their PA rent rebate credit. So it actually gives them a little bit of a boost. Now, our system does not calculate that. That's actually done at the state level. So they will actually go ahead and automatically increase any refunds coming through. So just to give you an idea of what we're looking at, so from homeowners, they actually have a little bit longer of an income threshold before it phases out. So from $0 to $8,000 of income, maximum rebate $650, $8,000 to $15,000 is $500, $15,000 to $18,000 is $300, and then $18,000 to $35,000 is $250. Now, I will say that unfortunately, I've run into situations where slight changes in income for the year may actually disqualify people. So I've seen, unfortunately, circumstances where someone has hit $35,012 and they are now outside the realm of the PA property tax rent rebate, and they will not qualify. So I've gone back to double check, wondered why TaxSlayer is not doing it correctly, and lo and behold, TaxSlayer had everything in there correctly. It's just that their income, when you go through the adding back of the 50% Social Security, railroad benefits actually would put them in a different category here in the filing matrix. For renters, it's even lower. So the first $8,000, if they're under $8,000, they get that $650 maximum rebate. If they're between $8,000 and $15,000, they can take up to a $500 maximum rebate. Anything above that, a renter will not qualify for the PA 1000 filing. Now, concerning the filing, there are a couple things that actually have to go with the return. So if the taxpayer lives in PA for the entire year, there's no Social Security statement that needs to be included. PA already has record of that. Now, we can attach a Form 1099 for pension, annuity, or other retirement income. But typically what we're doing at our sites is just attaching page 1 of the 1040. And that's actually sufficient information for the PA property tax rent rebate claim to be processed. Now, that's not the only thing we need to attach. It's going to be the PA 1000, which is going to have to be signed by the taxpayer. We need a copy of page 1 of the 1040. But then, depending on whether you're a homeowner or a renter, you're going to need to attach some additional documentation. So the biggest thing we see is receipted tax forms. So these are getting an actual copy of a paid bill from your local tax office. So as a homeowner, you can go down to your local tax bureau and ask to get a receipted copy of your tax forms, and that can be attached and sent with your PA 1000. Oftentimes, we'll probably see individuals coming into VITA already with the documents in hand. So it actually works out pretty nicely. If they don't have a receipted copy of their taxes, they can actually submit a copy of the tax bill, that form that comes out twice a year, and both sides of a copied check, of a canceled check, could be submitted, and that would also work. The third option we'd have would be if the individual is still paying a mortgage and their mortgage is escrowed. So effectively that their mortgage company is paying the real estate taxes on their behalf. So if they have a year-end mortgage statement of Form 1098, that'll show how much real estate taxes were paid. That also could count to proof of real estate tax payment. Now, for a renter, they're actually not going to have these. They actually have to have a PA rent certificate form completed and signed by their landlord, and that actually has to be included with the rebate claim. As we mentioned, typically our clients will come in with a number of these forms. We can help them put together as much as possible to make sure that that form and application is complete. That way, everything is all set. The state will go ahead and then process this at some point, and hopefully over the summer, start issuing their rent rebate checks. If not, we have to send them back with the additional required documentation to have them put it together. But we have seen situations where people have come in, pretty much have everything ready for us, and all we have to do is help put it all in the form together and let them seal the envelope and put a stamp on it, and then they're all set. All right, so what happens if an individual is applying for the first time? Well, for first-time filers, we do have to go ahead and prove their age. So this is only going to be for age 65 and older, only need to do an age requirement. Now, the first thing that we notice is that they say copies only. So we don't give the actual document. So we don't want to send anything to the government because we won't be getting it back. So we have to make a copy. The very first document that they want to see, this always is very, very puzzling to me, because if you've ever seen a copy of a birth certificate, or the actual birth certificate, I should say, in very clear language, it says, do not photocopy this document. So you're not allowed to copy the birth certificate. However, for the PA property tax rent rebate, one of the first documents they're asking for is a photocopy of their own document. So this is actually on file with PA, and they want a copy of your own birth certificate. So you're not supposed to copy it, but I guess for this purposes, you're allowed to do it. In my mind, they should have said on the birth certificate, do not photocopy unless needed for proof of age for the PA property tax rent rebate claim. Hospital birth records count. This was kind of a predecessor to some birth certificates. So usually the hospital could issue a birth record. Hopefully people have updated that now, because those are not eligible to go ahead and apply for passports. The one that we typically see is a driver's license. So typically people coming into VITA have to bring a form of ID, and a driver's license is the best one for that. We can actually make a photocopy and send it with the PA 1000. So the driver's license is probably our best proof of age. If they have a passport, if they have a PA ID card or a Medicaid card or a PACE or PACENet card, those also qualify as well. If they're a widow or widower, age 50 to 64, they need to provide the same proof of age as before. Generally, probably the driver's license is our best option. They also need to show the death of their spouse. So they need to go ahead and bring in a copy of the death certificate. So if they have an extra copy, we can send that. If not, we can have a photocopy and send that as well. Now, for the last category, anyone age 18 or above permanently disabled, if they're on Social Security Disability or SSI, all they have to do is provide a copy of the award letter. So they'd actually have a copy of that from SSI saying that they're disabled and receiving benefits. If they are on a VA administration or Veterans Administration disability, they can just simply provide a copy of the VA letter stating that they are on disability. If they do not have either one of those, they actually can provide a signed physician statement. That's a PA 1000 PS. And the PS stands for physician statement. So as long as they have a completed physician statement, that can also help them qualify and show proof of disability. Now, before I switch gears and head back into the federal section, just want to make a quick reminder about the local returns. So I mentioned about PA and having to understand where the school district is. That is needed for the PA return. For the local returns, we also need to know what municipality they live in. So if we're going to be preparing a local return because of earned income, we need to find out not just the school district, but also their 6-digit municipality code. So for all of our VITA sites, we actually have a link to the PA MuniStats program, which as long as you put that taxpayer's address in, it'll actually search the database and give you the exact location of where they're at. So it should give you the record of where they're at for a local earned income tax and also for purposes of the school district. So just want to throw that as a quick reminder, and you'll probably get some more training on that as we get closer to tax season. So switching back a little bit to some items that would be on the 4012. So take a look at deceased taxpayers. So one unique aspect we run into here, a couple things if we have a deceased taxpayer. So K-19 is going to give you a little bit more detail of what happens if we have a return dealing with someone who's deceased. So the first case, if we have a married filing jointly couple, if they've been filing jointly and one of the spouses has passed away during 2021, that couple can still file married filing jointly, so long as that surviving spouse did not remarry before December 31st, 2021. The surviving spouse can actually sign on behalf of the deceased spouse, and all we have to do is check taxpayer's deceased box in the basic information in order to generate date of death box. One suggestion we have is that if you have a married filing jointly return, you can actually bring that return over to the current year, bring all the information over, and then you can go back in and change the social security number and name and birth date and all the other relevant information, and put the surviving spouse as a primary taxpayer. So we want to put the deceased taxpayer as the spouse. So that way, when we roll it over again for the following year, that surviving spouse is going to be the primary taxpayer. It's also going to change it for the IRS that all the correspondence should first go to the primary taxpayer. So that'll be the surviving spouse. Now, if you have a surviving spouse, no problems here. They can sign on behalf of their deceased spouse. We can still get the refunds. That is not really an issue. However, if we have a situation where there's no surviving spouse, if the individual was single or their spouse had died before, then we need a personal representative to actually file and sign the return. So this can be someone who's actually given the power as an executor or administrator or someone who's in charge of the property. So as long as there's no taxes due, it's still a relatively easy process. You can still e-file PA and federal. So it's a fairly straightforward process. Where it gets a little bit more complex is actually claiming a refund for someone who's deceased. So in order to do this, we actually have to complete a form 1310. And the 1310 is going to go through a couple pieces and determine whether or not there's a court-appointed representative. If so, certain documents need to be attached. If we're filing the 1310 and we go through a couple options of the relationship of that individual to the deceased, if you're selecting option A or option B, we have to actually file the entire return by paper. We cannot actually e-file that return. So sometimes we actually have to do the paper filing with the court appointee documents attached. However, if it's the option C on the 1310, and again, you only need that if you get to that part, you can actually still file electronically. But if you select option A or B due to the relationship, we're probably going to have to file that by paper. Okay, so heading into our final stretch for our training here for 2021, wanted to talk a little bit more about military taxpayers. And we are eligible to prepare military returns. This is the 6th year we've actually been doing this. This is actually an advanced certification. So it's not in the advanced program. It's actually a separate certification. So if you want to take and try for the test and pass that certification, you can actually prepare returns for military issues. So if you do see one, be sure that you kind of point that out for a variety of reasons. One, first, you need to be certified with military tax in order to prepare it. And we also need to have a quality reviewed. But that actually allows a better opportunity for VITA staff to be exposed to these issues. You can certainly take your time. The military returns can be a little bit more complex, but this might help your site coordinator, other volunteers be a little bit more comfortable in what we're doing with the military returns. Now, we may not see quite as many simply because we don't live near an active military base. So we don't really anticipate seeing a lot. So we're probably not going to see some of the more complex issues like combat pay and moving allowance, but we are going to talk about those. So I do just want to mention that the best information for military is not coming out of the 4012, but actually coming out of the Form 4491. So it's a publication from the IRS that has a lot of really, really good information. So particularly if you're studying for the exam, whether it's military or whether it's advanced or basic, the 4491 is a great tool because it provides a lot more detail into a lot of the areas we've talked about throughout our training here. So just want to kind of remind you the 4491 is a great resource to refer to as well. Give you a little bit of an overview. So typically, a military individual will be getting a W-2 from the Department of Defense, usually DFAS, with the includable amount of income in box 1. So what we're going to see is that in box 1, they're going to show you how much income is going to be taxable. So there are a couple interesting codes that you're going to find on a military W-2. They're going to have some very unique ones in box 12. They are going to just enter them into software like anything else. If you're curious about what they are, the D12, the D2 on the 4012 will show you what all those codes would be, or the taxable and non-taxable expenses. We're also going to talk a little bit more about moving expenses a little bit later, and also that service members can actually take unreimbursed expenses on a Schedule A. So not available to the general public, but actually the military individuals can take some employee expenses. So as we mentioned, generally taxable income is going to be reported on box 1 of the W-2. One issue that may arise is for separation of service. So if an individual is separating from service and it's a result of a medical condition, typically that is still considered severance pay. So even though they might have a medical reason why they're no longer inactive service in the military is going to consider that service pay or severance pay and be considered taxable income. However, most often the individual will then appeal that determination to the VA and see if that can, the medical condition can be considered disability. If the VA determines that it is actually disability, they're going to give you an award of disability compensation. So that's actually going to be a VA letter that determines that they have concluded that the separation of service is due to disability. The compensation is now excludable, so it won't be taxed going forward. However, we may need to go back and file an amended return. So the year that the VA determination letter comes out, we can go back and basically amend the prior year returns to, excuse me, to go ahead and treat that other income as non-taxable. So the award letter actually is retroactive. It's going to make that prior compensation non-taxable. So if that occurs, we probably have a amended return we need to file. So generally, it's only going to be an issue the first year that we get that disability letter. Combat pay, if an individual is serving in the combat zone, the combat pay is not taxable. So it's not actually going to be included in box 1, but it will be listed in the W-2 box 12 with the code Q. And what we do with that code Q is that's actually can be treated as taxable income to increase earned income credit. So we can actually use that combat pay for earned income credit purposes to effectively get a much higher refund. And what's really unique for the current year, we actually have the age changing. So now anyone age 19 and above can claim the earned income credit as long as you're not a full-time student. So we may see more military members actually qualifying for earned income credit. As you can probably tell, most people do not wait till the age of 24 to enlist. So we might see more and more people eligible for the earned income credit for combat pay. A couple other things. We have homeowner assistance and basic housing allowance, not taxable for federal purposes and will not be reported as taxable income. For state purposes, gets a little bit unique for state purposes. So any compensation earned by Pennsylvania residents is generally taxable. That includes any active military duty pay earned while you're inside PA. So if you're active and you're inside PA, you're stationed here, that is taxable income. However, active military duty pay earned while outside PA is exempt. Most times that W-2 coming from the government will not have the correct amount of PA income or Pennsylvania tax withholding. So what we have to do is actually go back and take a look at the military orders. So typically most people in the military will know to go ahead and bring either Title 10 or Title 32 orders in to show where they've been. And we can go back and recalculate how much of that should be considered PA taxable income. And we can send a copy of the military orders and the W-2 with the return. If we don't have the military orders, you can get a statement from the commanding officer detailing whether they have been inside or outside PA, and it has to be for active military duty. PA fortunately has a very nice brochure, the PA REV 612, which describes a little bit more about military pay, which ones will be taxable and which ones are going to be exempt here in the Commonwealth. I alluded to our moving expenses, and moving expenses are actually deductible for military people as long as we see a permanent change in station. So we don't often see it here in Central PA because we don't actually have any active military bases here in South Central PA. But if we do have that, or if you have friends and family you're working with, you can actually have a deductible change or move for a change in permanent station. So that'd be the cost of moving your household goods and personal effects, along with travel and lodging expenses. So it has to be reasonable. It has to be a direct route going through kind of the normal process. No sightseeing, no additional stops along the way. But as long as it's reasonable travel and lodging, we're okay. Only expenses paid by the service family or their service member are deductible. So if they're getting reimbursed from the government or someone else, those amounts are not deductible. Only the amounts over the reimbursement will be deductible. If we have any moving expenses, you can use the form 3903 to report those on the return. Now, the military will generally offer to move the service member's items and belongings for them. However, the service member can decide that they would wish to do it on their own. So the military is going to go ahead and calculate how much they think it would cost the government to move all the items, and will actually pay for 95% of the government's cost to move it. So if you're going to move on your own on a personally procured move, or what used to be called a ditty, the do-it-yourself, what we're going to take a look at here is you can move your own belongings. You have to submit all your receipts to substantiate the actual expenses. If somehow the cost of you moving was less than what the government would have incurred, that excess part, the excess reimbursement, is going to be taxable income and would be reported on a separate W-2. If you have more costs for moving, basically any mileage, lodging, that type of thing in excess of the reimbursement, you can take that as a deduction, and that would be again on the form 3903. So the last area I want to cover with our tax training for 2021 is our military business expenses. So military business expenses are allowed for federal purposes. So what we're going to take a look at this would be allowed for a Schedule A deduction. So it would have to be reported on a itemized deduction. So most people aren't eligible for this, but military still would be. So what we're basically taking a look at are unreimbursed uniform expenses. That could include cleaning. That can be deducted if they're required for employment and they're not suitable for general use. Basically, they're prohibited for off-duty wear. So basically, if they are not allowed to wear their uniforms while they're not on duty, any of the costs of cleaning or items that are basically required insignia of rank or maybe core devices or epaulets are deductible. So you can actually deduct these as business expenses. One that we might actually see a little bit more of is actually the third bullet point here. This is travel expenses for reserve officers while they are away from home. So if you're reporting for reserve duty and we have a 100-mile rule, so as long as your reserve duty is more than 100 miles away from your home, you can actually take travel expenses as a deductible expense. So that would be allowable as a military member. If we have professional dues, as long as they're incurred for basically assisting in your business use, they can be deductible. You cannot take officer club dues or NCO dues. Any social club dues are not deductible. Educational expenses are also deductible as long as they're still required for the current trade or business. So if you're attending flight training and you're going through night vision training or you're doing some instrument training, that is deductible. However, if you're a pilot and you've decided that you want something more exciting in your life and maybe you'd like to be an accountant, you cannot take those educational expenses. That's going to qualify you for a new role or position. So that would not be eligible for educational expenses. So again, the 4491 is going to provide a lot more detail for the military activity. So if you have any of these, if you want to go for military certification, we would certainly appreciate that. If you want more knowledge about that, the 4491 is a great place to get your question answered and also have you very well prepared for the exam. So that actually takes us to the end of our kind of formal presentation here. So wanted to open it back up again for any questions that might have arisen since our last break.
Sorry, I was on mute. Jared, no, there weren't any questions related to the tax. Michelle, maybe you can just go back over some of the points to summarize from this morning.
Sorry, Jeff, I had to unmute too. All right, so I just wanted to remind everyone that we will be doing open sessions. They will be at Millersville. We won't be at HAC this year. So Millersville in the computer lab, 2:30 in the Cumsey Hall. We'll also be offering them via Zoom. Our hope is that the practice lab at that point will provide us with state and local. If that's the case, we will have carve out like a half hour of those sessions to do this. If not, we'll look at how we can get the new volunteers trained in state and local before they get to the sites. So the other thing that I just wanted to talk a little bit about was site protocols. So we will be requiring at all sites for there to be properly worn masks by both the clients and the volunteers. So it'll be up to us to police that. You know, clients do have a tendency to sometimes, you know, move the mask down over their nose or think they need to take the mask off to talk, but just to remind them that they need to wear their masks properly at all times while they're in the site. We will be reducing the number of clients and volunteers that are in a site. Large sites like Ephrata, it shouldn't have an impact on, but some of our smaller sites, for instance, VITA Central, we won't have the 6 preparers that we used to have there. We'll probably be down looking more at 4. We'll only be allowing the client and the client's spouse. If there's a joint return, we will not be allowing children into the site. If a client comes with children, they'll have to put the children back into the car and one of the spouses will need to sit with them, but they'll be notified that up front when they schedule their appointments, that those will be the expectations. We will not be asking for vaccination certificates. We will not be providing any barriers, plexiglass barriers for the volunteers to use the sites. There'll be hand wipes, there'll be antibacterial, there'll be, you know, you'll be encouraged to wash your hands, you know, after every client. But at this point, that is the best that we're going to be able to do. The United Way will be coming out with their guidelines The guidelines will be more along the lines of, for instance, if I were to test positive tomorrow with COVID and I had been around Jeff, I would notify our HR, I'd notify Jeff so that he was aware, and then, what I would need to do to, from a protocol standpoint. So those are what we're looking to do. We know that it is, as I said earlier, a very complicated time. And I know this may be, as a volunteer, you may feel uncomfortable. And so if you are hesitant at all about volunteering, please do not sign up to do any of the shifts. We build our client schedule based on what is in the volunteer schedule. So if you're hesitant, please wait till a time where you feel more comfortable to sign up. If there's other questions that you have, we are certainly willing to talk to you about them. But again, it's going to be up to the site coordinator at each of the locations. There'll be a sign at all the sites, properly worn masks required to enter. If a client did have a disability, let's say they had an oxygen mask that they were required to wear, we will make an accommodation for them. They still will not be allowed into the site. We would come out, and we expect this would be the exception versus the norm. We would then go out and accommodate them doing the intake at the car, and then come back into the site to prepare the return, go back out to the car to review it with them. So at this point, that is the protocols that we will have in place. As things change, we will modify potentially what we're doing, but that's the best we're able to do for now. So I hope that answers everyone's questions. If not, feel free to reach out to me separately, and I'll be happy to talk to you about this. There's a question here: when will sites be open? So we will start opening sites on Martin Luther King Day on Monday. We will have a gradual rollout. So the week of Martin Luther King, you'll see a lot of the sites open. Some will open the next week. Some will open the following week. So that should all be in VSP at this point in time. Any other questions? So if not, I'm going to say thank you to everyone for joining us tonight. Jared, thank you so much for sharing your expertise and knowledge with us. We really value what you're able to provide to our program. And to everyone, have a very Merry Christmas, Happy Hanukkah, Happy Kwanzaa, whatever you celebrate. We wish you the best, and we look forward to seeing you in our open sessions in January. Thank you.
Thank you, everyone.